Hey guys, welcome back to another video. Today we're going to be covering one of the important components of the discounted cash flow model, and it is the projection of net working capital, one of the three components necessary to projecting the unlevered free cash flow of a company. So let's get started. When projecting the unlevered free cash flow of a company for a discounted cash flow analysis, one of the key assumptions is the projection of the net working capital needs of the business. And so just to recall the calculation, once you have your earnings before interest and tax, EBIT, and you take away taxes at the marginal tax rate, you'll get your net operating profit after tax, or your earnings before interest and after tax. And so afterwards, you can add back depreciation and amortization, non-cash charges, and then take away capital expenditures and take away an increase in net working capital or add a decrease in net working capital to get your unlevered free cash flow. Right? So that's just a general calculation. And so in this video, what we're going to be focusing on is just one component of that free cash flow calculation, and it's going to be the net working capital needs of the business. And in school and for students, probably a lot of the times teachers have said, oh, you know what, you're going to learn about it in the industry, we'll learn about it later. And so they always assume a percentage of sales method. You look back at the historical percentage of sales of net working capital, and based on that assumption, you then project it out. And that's a quick and dirty way of looking at it, and we'll talk about that later. But there is a much more accurate and defensible way to project net working capital. And especially for professionals in the industry, you need to defend your projections. If clients are going to ask you, why is this valuation the way it is, you have to go back and talk to your assumptions and say that this is why that is happening. Right? And so this is why it's so important to really have sound projections. And so this is what we're going to talk about today. So going back over here, an increase in net working capital is a use of cash. A decrease is a source of cash, right? So thus, an increase in net working capital would reduce free cash flow to the firm, and a decrease in net working capital would increase free cash flow to the firm. And this is interesting. Why would an increase in net working capital take away cash? Why is that a source of cash and therefore reducing free cash flow? Well, with net working capital is considered non-cash current assets less non-interest-bearing current liabilities. So if you're increasing net working capital, the difference between current assets and current liabilities, you're tying up more of liquid cash into this illiquid current assets, right? So it's a little bit more difficult to liquidate those current assets relative to, cash and equivalents. And that's why it's considered a use of cash. Whereas a decrease, where you're decreasing the net difference between current assets, non-cash current assets, and non-interest-bearing current liabilities, that is a source of cash because less cash is tied up. Okay, so net working capital is typically defined as non-cash current assets less non-interest-bearing current liabilities. It serves as a measure of how much cash a company needs to fund its operations on an ongoing basis. So it does not include cash and equivalents and current debt. And this is so important. I always see a lot of people in case competitions or students where they're net working capital calculation is just taking the total current assets on the balance sheet less current liabilities, and they actually include cash. That is incorrect. Net working capital in the calculation for the projection of free cash flow excludes that, and that's very important. Okay, so the things that we do include for the current asset side are accounts receivable, inventory, prepaid expenses, and other current assets. And for current liabilities, it's accounts payable, accrued liabilities, and other current liabilities. So the formula for net working capital is accounts receivable plus inventory plus prepaid expenses and other current liabilities, or non-cash current assets less accounts payable plus accrued liabilities and plus other current liabilities. So less non-interest-bearing current liabilities. And so the calculation for the change in net working capital, the number that we're going to be using in the free cash flow calculation, is the difference between the net working capital this year versus last year. So if it increases, then we're taking away from free cash flow, and if that decreases and therefore net working capital, the change in net working capital is negative, then we're actually adding to the free cash flow calculation. Okay, so the change in net working capital from year to year is important for calculating free cash flow, as it represents an annual source or use of cash for the company. An increase in net working capital over a given period is a use of cash. This is typical for a growing company, which tends to increase its spending on inventory to support sales growth. Conversely, an increase in accounts payable represents a source of cash, as it is money that has been retained by the company as opposed to paid out. And so that's what we were talking about before. So a lot of the time, students misunderstand what that change in net working capital represents. When the difference between current assets and current liabilities increases, that's a use of cash because you're tying up cash in those current assets, those non-cash current assets. Okay, so there are two ways to project changes in net working capital. The easy way, the quick and dirty way, in which probably you've learned at the undergraduate level, is essentially the shortcut for projecting year-over-year changes in net working capital involves projecting net working capital as a percentage of sales at a designated historical level and then calculating the year-over-year changes accordingly. And so the change is based upon the change in sales growth, the top line growth. Okay, and the second and a more granular and recommended approach where possible is to project the individual components of both current assets and current liabilities for each year in the projection period. Net working capital and year-over-year changes are then calculated accordingly. So the much more accurate and industry standard, which second or first year analysts do at the investment banks, is that they project the individual components of current assets and current liabilities based upon whatever uses and expenditures are expected, and then they sum that up to calculate current assets and current liabilities, and then they calculate the difference, and that provides a much more accurate and defensible projection than just going percentage of sales. Okay, so let's look at method number one, the quick and dirty projection. So consider a company like Liquor Stores NA. I publish a lot of research on Seeking Alpha. This is one of the companies that I cover, so that's why I always use them in my videos. And if you are interested in learning more about that company, please do check out my Seeking Alpha profile. So it's in the video description. But looking at the company, you can use the analyst sales estimates for the next 3 years and project net working capital based on the 13.75% of earnings. So let's actually make sense of these numbers. So here we have the sales line. So these are projections. So starting into 2013, 2014, 2015, 2016, these are existing numbers. So right now we're in 2017 and I'm using year-end numbers. So these are all real sales numbers. Now projecting free cash flow out, you can actually take the estimates that analysts have reported, and there's tons of online resources that provide those numbers, and then based on those estimates project out the company. And that's a very easy and quick way to project net working capital. And the way to do that is to look back at the historical performance of net working capital. So here we have non-cash current assets through 2013 to 2016, and here we have non-interest bearing current liabilities through 2013 and 2016. And so we have accounts payable, inventory, prepaid expenses, and then accounts payable, income taxes payable, and dividends payable. Okay, and so these are all real numbers that they've been reported. You can sum them up and then calculate based on this the total net working capital. So if we sum up all of these current assets, that gives us 140,583, and these are in thousands of dollars. So this would be 140 million, and then the total for current liabilities, non-interest-bearing liabilities, would be 46,403. Right? And so that difference gives us a total net working capital in 2013 of 94,180,000, right? And then in 2014, net working capital increases to 95 million, right? So that change represents a use of cash. The difference is positive, and therefore, free cash flow reduces because we're tying up more cash, right? But for us and for the method number one, what you want to do is you want to take that number and then look at sales and divide this number by sales to calculate the percentage of sales tied up in total net working capital. And even though this company, which has been going through some struggles and it's been struggling due to the fall in oil prices and its position in the market, even with that volatility in sales, which comes later on, you'll actually see that the percentage of sales when looking at net working capital is relatively consistent. It ranges within 2%, right? So that's a relatively consistent metric and a very quick and dirty way of doing things, right? So you calculate the percentage of sales for 2013, 14, 15, 16, and then you can calculate the average of that or use the most recent period if you feel that that's more reflective of the current environment. And so then you take that 13.75%, you look at your the analyst expectations and projections for the next 3 years for sales, and then you multiply this number by those projections, and then you can calculate for the next 3 years, relatively accurate assumption of what where net working capital will be, right? And so this is the quick and dirty way. So method number 2, we're projecting individual components. A company's current assets and current liability components are typically projected on the basis of historical ratios from the prior year level or a 3-year average. The most common ratios are the day sales outstanding, the DSO ratio, the days inventory held, the DIH ratio, the inventory turns ratio, and the days payable outstanding ratio, the DPO. So don't worry, you don't know them yet. We're going to go through each of these ratios and how they apply to different components of the current assets and current liabilities of a company. Okay, and so essentially what I want to get across right now at the beginning is that these ratios are then going to be used. Either we can use the most recent year's ratio because we're assuming that, it's much more relevant than the historical ratio because of changing market conditions, or we kind of average the past 3 years, that the 3-year ratio, we average it out and use that ratio to then project it. And so we're going to look through that and we'll see how that's actually done. So how do we project accounts receivable? Accounts receivable refers to amounts owed to a company for its products and services sold on credit. Accounts receivable is customarily projected on the basis of days sales outstanding, the DSO ratio. And essentially the DSO ratio is calculated by taking the accounts receivable in the most recent year-end period and dividing by sales and then multiplying that by 365 days in the year, right? And so the DSO ratio measures the number of days it takes to collect payment after the sale of a product or service. Okay, so the DSO provides a gauge of how well a company is managing the collection of its accounts receivable. And companies strive to minimize their DSO so as to speed up their collection of cash. Increases in a company's DSO can be the result of numerous factors, including customer leverage or renegotiation of terms, worsening customer credit, poor collection systems, or change in product mix. Okay, so when we're projecting accounts receivable, what we can do is we use the DSO ratio. We look at the most recent year-end number or the most recent quarter-end number. We divide accounts receivable by sales, multiply it by 365. Actually, in that case, you'd only use the year numbers because it's 365, right? And so we can kind of see historically, has that DSO ratio been increasing or decreasing? If it's been increasing, then that's a bad sign because that means that it takes longer and longer to collect payment after the sale of a product or service. If it's decreasing, then maybe we can kind of assume a continuation in that trend, right? And so that's what we're trying to do. Now we'll talk more about that, but this is how the ratio that you would use for projecting accounts receivable. So what about projecting inventory? Inventory refers to the value of a company's raw materials, work in progress, and finished goods. It is customarily projected on the basis of days inventory held, DIH, the DIH ratio. So the DIH ratio is calculated by dividing inventory by the cost of goods sold, COGS, and then multiplying that by 365. Right? So DIH measures the number of days it takes a company to sell its inventory. For example, a DIH ratio of 90 implies that on average it takes 90 days for the company to turn its inventory. Essentially, turning its inventory means that I have X amount of units and I've sold all of those X amount of units without adding any new ones, right? And as I add more, how long does that unit take to be sold, right? So if it means 90 days, then on average it takes about 90 days to kind of draw down on my inventory. If it takes 60, then it's less and it's better because the velocity of inventory is increasing as this ratio declines. And the same thing as with projecting the DSO ratio for accounts receivable. If it's increasing, then it's a bad sign and we can project a continuation in increases without changes. Or if it's decreasing, then we can project, favorable terms with regards to inventory. Okay, so an alternative approach for measuring a company's efficiency at selling its inventory is the inventory turns ratio. Inventory turns measures the number of times a company turns over its inventory in a given year. As with a DIH ratio, inventory turns is used together with COGS to project future inventory levels. So relative to the DIH ratio, where we're dividing inventory by COGS and multiplying by 365, here we're dividing COGS by inventory. So we're kind of flipping it around and taking away the times 365, okay? And so this is another way that you can use it. And we'll talk about how these ratios are then used in projections. But this is just talking about the ratios themselves and analyzing the historic performance of each of the individual components. Okay? So what about prepaid expenses and other current assets? Prepaid expenses are payments made by a company before a product has been delivered or a service has been performed. Prepaid expenses and other current liabilities are typically projected as a percentage of sales in line with historical levels. So in this case, outside of accounts receivable and inventory, you can use the percentage of sales method, although you should still be projecting them based on the individual components. So you would look at the balance sheet and input all of the necessary lines of data, all the necessary accounts, and then based on those account levels, based on prepaid expenses and other current assets, you calculate the percentage of sales. So you wouldn't sum them up. You'd break them down for each component. Okay? So what about on the current liability side? Projecting accounts payable. So accounts payable refers to amounts owed by a company for products and services already purchased. Accounts payable is customarily projected on the basis of days payable outstanding, DPO. Now the DPO ratio is calculated by dividing accounts payable by COGS and then multiplying by 365. The DPO measures the number of days it takes for a company to make payment on its outstanding purchases of goods and services. For example, a DPO ratio of 45 implies that the company takes 45 days on average to pay its suppliers. Okay, and so once again, looking at this ratio, we can go to the final year-end value, take the accounts payable, divide it by the cost of goods sold of that period, and then multiply it by 365. If it increases in value, then that means that the company takes more on average to pay its suppliers. If it's decreasing, then we're paying our bills faster, and that's good. So if it's decreasing, it's good. If it's increasing, it's bad. So what about accrued liabilities and other current liabilities? Accrued liabilities are expenses such as salaries, rent, interest, and taxes that have been incurred by a company but not yet paid. As with prepaid expenses and other current assets, accrued liabilities and other current liabilities are typically projected on a percentage of sales in line with historical levels. So this is once again one of those places where you can break down each of the line items, calculate the percentage of sales for each of those line items, and then project them outwards, and afterwards summing them up. So you don't sum them up and project them based on percentage of sales. You break them down, you find each of the line items, calculate the percentage of sales on historical levels, you look at the trends, similar to the other current assets, you look at trends. Through your due diligence, you've become familiar with that company, and you understand whether the prepaid expenses or current assets are increasing or decreasing, and then you can kind of make that judgment. But based on percentage of sales, it's safe to assume that accrued liabilities and current liabilities and prepaid expenses and current assets can be projected. Okay, so how do we implement these ratios? Once you've calculated the ratios for the past 3 years, determine whether the average or most recent year is suitable for projection. The ratio is then used to project each of the components. To do so, you need to know COGS and sales. This can be easily projected in the early years by using consensus estimates for earnings. For COGS, using a percentage of sales method gives you a great estimate of costs. So essentially, how do you use these ratios? So when you're looking at the DPO or the DSO or the DIH ratios, each of those ratios either require COGS or sales. And we have the other numbers, which we already know about, right? So we can go back into the previous year and we look at the accounts payable. So let's take an example. Let's look at DPO. So for DPO, COGS is the key here. Essentially, we can take the projections that analysts have provided for us and based on a percentage of sales, project our COGS for the next year. And then we know 2 of the 3 variables necessary to calculate the DPO ratio. So if analysts have projected, next year a company is going to make $100 and COGS says that 70% of the earnings is put towards cost of goods sold, then we know that next year we can assume that COGS will be around $70. So we know 70 times 365, and all we need to know is accounts payable, which we're trying to project, right? So if we rearrange the formula and we take that historical value of the DPO value, right, we can rearrange it so that we isolate for the accounts payable and use the DPO ratio, the historical DPO ratio, the projected COGS, and 365 days to then calculate the accounts payable. So we kind of flip it around. So we take the ratios, we calculate the average historical ratios. Once we've decided on whether the most recent or the 3-year average is most suitable, we then input that into the formula. We project our COGS or sales, whichever ratio we're considering, and then we isolate for the necessary projected thing, whether it's going to be accounts payable, inventory, or accounts receivable, right? So let's look at the DSO ratio. So for the DSO ratio, it's much simpler. We don't even have to assume percentage of sales for COGS. Here, all we have to do is we have to take analyst estimates. So projecting for the future, we've taken and we've assumed that the DSO ratio is 2, right, based on historical numbers. We know 365 already, and we know that based on analyst estimates, the company's going to make $100. Right? So we can move them around and isolate for accounts receivable, and then that is how we project accounts receivable. And I believe that is really, this is another example. So once you know both costs and earnings, you can use each of the ratios to project the components. Consider days sales outstanding, the DSO ratio for accounts receivable. So we have here, we already talked about this, but I'll go once again because this is really important if you don't understand. So say, for example, we determine that the average DSO ratio for ABC Corp is 32.5. So there's 32.5 on the left-hand side. With projected sales of $120,000 in year 1 and $135,600 in year 2, we can calculate accounts receivable. So these are the projections based on analyst estimates. Or if we feel comfortable in making our own projections, then you can project it for whatever you want. But you're basing it on that projection, right? And so what you do is you just calculate the accounts receivable, right? So for year 1, you would input 120,000, the projection. On the left-hand side would be 32.5. That's the DSO ratio. And so you isolate for the left-hand side on accounts receivable, and you do the same thing for year 2. So therefore, accounts receivable in year 1 would be $10,684, and in year 2 it would be $12,073, right? And so that's an increase, and which makes sense because our sales have increased. If sales have decreased, then the accounts receivable would decrease from year to year, and that's a fair assumption to make. If you're projecting sales growth, your net working capital needs should be positive. They should be increasing because the business needs to use more of that cash, to fund ongoing operations. But this is how you project it, and this can be applied to the DIH ratio or the DPO ratio, right? So once you have your projection of either sales or COGS, you can isolate for the respective variable that you're trying to project, and then you can project that variable based on and it has to be that you're projecting sales or COGS very accurately. So even though you've gone and you've calculated the DSO ratio, if your projection of sales is incorrect or is significantly off, then your projection of accounts receivable will also be off. But for analysts or for students in case competitions, this is very good because you already have existing projections in the market. You have professional analysts in the market who have been analyzing these companies for a long time, and they are relatively confident that the projections are within the range of how the company should perform. And therefore, it is much easier and much more accurate to project accounts receivable using this method. Okay, so a quick overview. For projecting the accounts receivable, you can use the DSO ratio, which is accounts receivable divided by sales multiplied by 365. For inventory, you have two methods. You can do the DIH ratio, which is inventory divided by COGS multiplied by 365, or the inventory turns ratio, where you divide COGS by inventory. So you flip it around and take away the 365. For prepaid expenses and other current liabilities, it's a percentage of sales. You project them on the individual components. And same thing for accrued liabilities and other current liabilities, percentage of sales. And for accounts payable, you use the DPO ratio. So you divide accounts payable by COGS and then multiply by 365. That's pretty much it. Hopefully the video was helpful. If you do have any questions, please comment below and I'll be sure to get back to you. If you did like the video, I would recommend that you subscribe to the channel. I have a lot of other videos covering investment banking topics, initial public offerings and other DCF videos. I do recommend that you check out my my video series on learning about the DCF model, the comparable companies analysis and the precedent transactions analysis. So these are all great videos if you are entering the investment banking industry. But if you did like the video and found it helpful, please do subscribe to the channel and like the video. Thank you so much, guys, and have a great day. Thank you.